Right now, as you're watching this, the same invisible forces that destroyed millions of lives in 1929 are quietly gathering strength in our financial system. And just like nearly a century ago, most people won't see it coming until it's too late. The warning signs aren't hidden. They're everywhere. We're just not looking at them the right way. Let's travel back to a Tuesday morning in September 1929. Picture the streets of New York City bathed in autumn sunlight. Men in crisp wool suits stride confidently down Wall Street, newspapers tucked under their arms. Women in fashionable cloche hats window shop along Fifth Avenue, their purses heavy with spending money. The air itself seems to hum with possibility. America has never felt richer, never felt more invincible. The stock market has been climbing for nearly a decade, turning ordinary school teachers and factory workers into paper millionaires. Everyone, it seems, has a hot stock tip. Everyone is winning. But let me ask you something. Does this sound familiar? Just 2 years ago, in 2023, we watched cryptocurrency enthusiasts become overnight millionaires. We saw teenagers trading options on their phones during lunch breaks. We heard stories of people quitting their jobs to become day traders, convinced the market only goes up. The feeling was identical. That electric certainty that we'd discovered a new era of permanent prosperity. In 1929, people called it the new economy. They genuinely believed they'd figured out how to eliminate the old boom and bust cycles that had plagued previous generations. Technology was revolutionizing everything. Radio was connecting the nation. Automobiles were reshaping cities. Electricity was lighting up homes from coast to coast. Sound familiar? Today we talk about artificial intelligence, blockchain, quantum computing. We use different words, but we're telling ourselves the same story. We've convinced ourselves that this time is different. The psychology driving both eras is identical, and understanding this psychology is crucial because it's the first warning sign we keep missing. Here's what was actually happening in 1929 beneath the surface glamour. Banks were lending people money to buy stocks. Not just wealthy people. Everyone. You could buy stocks with just 10% down, borrowing the rest. It was called buying on margin. Imagine borrowing $90 to add to your $10 so you can buy a $100 stock. If that stock goes up to $110, you've doubled your actual money. You put in 10, you sell for 110, you pay back the $90 loan, and you've got $20. Your 10 became 20. That's a 100% return. Sounds amazing, right? And it was amazing as long as stocks kept rising. But here's the trap that nobody wanted to think about. What happens when that stock drops to $90? Now you own $90, but your stock is only worth $90. You have nothing left. Your entire $10 investment is gone. And if it drops to $80, you owe more than the stock is worth. The bank comes calling. They demand you either put in more cash immediately or they'll sell your stock at a loss. This is called a margin call, and it's financial quicksand. By the summer of 1929, margin debt had reached levels never seen before in American history. Everyday people had borrowed billions of dollars to chase the dream of easy wealth. And here's where it gets chilling. In 2021 and 2022, margin debt in the American stock market reached all-time record highs, exceeding even the peaks before the 2008 financial crisis. History wasn't just rhyming. It was repeating word for word. But there's something even more dangerous than margin debt itself. It's what margin debt does to human psychology. When you've borrowed money to invest, you can't afford to believe bad news. Your brain literally starts filtering out warning signs because accepting them means accepting financial ruin. Psychologists call this confirmation bias. In 1929, investors dismissed every warning as temporary noise. They'd been conditioned by years of rising prices to believe that dips were buying opportunities. The market always came back, until suddenly it didn't. The first cracks appeared in September 1929, though almost nobody recognized them as cracks. Stock prices started behaving strangely. They'd surge in the morning, then give back all their gains by afternoon. Trading volume became erratic. Some of the smartest investors, the insiders who really understood corporate finances, began quietly selling their positions. Not loudly, not with announcements. They just slowly, carefully started getting out. And here's what's fascinating. In early 2025, we're seeing the exact same pattern. Major tech company executives have been selling shares of their own companies at rates we haven't seen in years. Not all at once. Quietly. Gradually. While publicly, they're still talking about growth and innovation and bright futures. Their actions and their words tell completely different stories. Just like in 1929. But ordinary investors in both eras missed these signals because they were focused on something else entirely. The narrative. The story everyone was telling themselves. In 1929, that story was about America's unstoppable industrial might. Today, the story is about technological transformation and digital revolution. Both stories are partially true. That's what makes them so dangerous. They contain just enough truth that people stop asking critical questions. October 24th, 1929. Black Thursday. The day the music stopped. It started with a whisper. A few large investors decided to take profits. Nothing dramatic. Just ordinary selling. But in a market built on borrowed money, ordinary selling triggers something extraordinary. Remember those margin calls? When prices started to fall, banks demanded more cash from investors who'd bought on margin. Those investors didn't have more cash, so they were forced to sell stocks to raise money. But their selling pushed prices lower, which triggered more margin calls, which forced more selling. A feedback loop, a cascade, a financial avalanche. By midday, panic had replaced confidence. Men crowded around ticker tape machines, watching their life savings evaporate in real time. The machines couldn't even keep up with the volume of selling. Prices shown on the tape were hours behind reality. People were selling blind, not knowing what they were getting, just desperate to get out. Millionaires became paupers between breakfast and lunch. Workers who'd invested their retirement money lost everything they'd spent decades saving. But here's the truly tragic part. Black Thursday wasn't even the worst day. The market rallied on Friday. Over the weekend, bankers and government officials assured everyone that the worst was over. The fundamentals were sound, they said. The economy was strong. It was just a temporary panic. On Monday, the market fell again. And then came Tuesday, October 29th. Black Tuesday, the day the bottom fell out completely. Over those few days, the stock market lost nearly 40% of its value. But that was just the beginning. The real catastrophe took years to fully unfold. By 1932, stocks had lost almost 90% of their peak value. 9 out of every $10 invested at the top simply vanished. Banks failed by the thousands because they'd lent too much money against stocks that were now worthless. When banks failed, ordinary people lost their savings. Not just investors. Everyone. People who'd never touched a stock found their life savings gone because their bank had bet on the market with depositors' money. Now let's talk about what's happening right now, in 2025. And I want you to really hear this. In March 2023, Silicon Valley Bank collapsed. It was the second largest bank failure in American history. First Republic Bank followed. Signature Bank went down. These weren't small regional banks. These were institutions handling hundreds of billions of dollars. And why did they fail? Because they'd made risky bets. They'd assumed interest rates would stay low forever. They'd assumed their investments were safe. They'd ignored warning signs because the previous decade had taught them that central banks would always ride to the rescue. Sound familiar? In 1929, banks failed because they'd made risky bets on an endlessly rising stock market. In 2023 and 2024, banks failed because they made risky bets on an endlessly low interest rate environment. The specific financial instruments were different. The underlying psychology was identical. Overconfidence, recency bias, the belief that recent trends will continue forever. But here's what keeps me up at night, and what should concern everyone watching this. The 2023 bank failures were contained. Government regulators stepped in. They guaranteed deposits. They prevented widespread panic. For now. But they did this by creating more money, by increasing debt, by essentially promising to paper over problems rather than solve them. It's like taking painkillers for a broken leg instead of setting the bone. The pain goes away temporarily, but the underlying damage gets worse. In 1929, the Federal Reserve had tools they could have used to soften the crash. They chose not to use them aggressively enough. They were worried about inflation. They were concerned about moral hazard. They believed markets should be allowed to correct themselves. By the time they realized how wrong they were, the damage was irreversible. Today, central banks have been far more aggressive. They've pumped trillions of dollars into the financial system over the past 15 years. They've kept interest rates artificially low. They've prevented any serious market correction from playing out naturally. And here's the question nobody wants to ask. What happens when you prevent small fires for decades? Eventually, you get a megafire. You get an accumulation of dry timber that turns a manageable problem into an unstoppable catastrophe. We've prevented the small corrections that keep markets healthy. We've convinced ourselves we can control complex systems that may be fundamentally uncontrollable. But let's step away from the financial mechanics for a moment and talk about something more important. People, real human beings. In 1929, the stock market crash didn't just destroy wealth. It destroyed lives. Families who'd invested everything lost their homes. Farmers who'd borrowed to expand their operations lost their land. Workers lost jobs as businesses failed in waves. Children went hungry. Dreams died. The psychological impact lasted generations. People who lived through the Depression never fully trusted banks again. They hoarded cash. They feared debt. They taught their children and grandchildren to be suspicious of anything that seemed too good to be true. We're at risk of creating that same generational trauma again. Right now, millions of young people have invested in markets at all-time highs. They've been told that investing is the only way to build wealth in an economy where wages barely keep pace with living costs. They've poured money into retirement accounts, into crypto, into tech stocks. They've done what they were told was responsible. And if those investments collapse, they won't just lose money. They'll lose faith in the entire system. They'll spend decades trying to recover. They'll make decisions based on fear rather than rational calculation. The damage won't be just financial. It'll be psychological and social. Here's what fascinates me most about comparing 1929 to today. It's not that we don't know about the Great Depression. We study it in schools. There are thousands of books analyzing what went wrong. Economists have spent careers figuring out the mistakes that were made. We know the story, and yet we're repeating it. Not identically, but close enough that the parallels should terrify us. Why? Why do we keep making the same mistakes when we know the consequences? I think it's because humans are fundamentally optimistic. We want to believe that this time is different. We want to believe we're smarter than previous generations. We want to believe that new technology changes the fundamental rules. And to be fair, sometimes it does. Sometimes optimism is justified. But the line between healthy optimism and dangerous delusion is razor thin, and it's almost impossible to see when you're standing on it. In 1929, people weren't stupid. They weren't ignorant. They were responding rationally to the information and incentives in front of them. Everyone around them was getting rich. The people saying the market was overvalued looked like fools as prices kept climbing. The social pressure to join the party was immense. Sitting on the sidelines felt like watching everyone else win while you stayed poor. The exact same dynamics are at work today. So what are the specific warning signs we should be watching for right now? First, margin debt. When investors are borrowing heavily to invest, that's a red flag. We saw record margin debt in 2021. It's come down since then, but it's still historically elevated. Second, bank stability. The 2023 bank failures weren't isolated incidents. They revealed fundamental fragility in the financial system. Third, corporate debt. Companies have borrowed trillions of dollars at low interest rates. As those rates rise, many companies will struggle to service that debt. Fourth, commercial real estate. With remote work becoming permanent for many businesses, office buildings are losing value rapidly. Banks have massive exposure to commercial real estate loans that may never be fully repaid. Fifth, and perhaps most important, valuation. Stock prices relative to company earnings are extremely high by historical standards. Not as high as they were in 1929 or in 2000 before the dot-com crash, but high enough to suggest that expectations have gotten ahead of reality. When expectations are too high, even good news can disappoint. But here's the crucial point. None of these warning signs guarantees a crash. Markets can remain irrational longer than individuals can remain solvent. Timing is nearly impossible. The danger isn't that we can predict exactly when things will fall apart. The danger is that we're vulnerable. We've built a system with very little margin for error. And history teaches us that when systems have no margin for error, they eventually fail. We stand at a crossroads that's eerily similar to where America stood in the summer of 1929. We can choose to listen to the warning signs, to prepare, to build resilience into our personal finances and our broader economy. Or we can choose to believe that this time really is different, that we've somehow transcended the cycles that have governed markets for centuries, that the rules don't apply to us. The people of 1929 weren't given the gift we have. They couldn't look back at their own story as a warning. We can. We have the privilege of historical perspective. The question is whether we'll use it. Whether we'll let hubris and greed blind us the way they were blinded, or whether we'll make different choices. Here's what I want you to understand. You don't have to predict the future to protect yourself. You don't need to know exactly when or if a crash is coming. You just need to be honest about risk. Diversify. Don't invest money you can't afford to lose. Don't borrow to invest unless you truly understand and can handle the consequences. Build an emergency fund. Learn to distinguish between investing and speculation. And most importantly, don't let the fear of missing out drive your financial decisions. The greatest wealth is often built not by chasing every opportunity, but by avoiding catastrophic mistakes. The story of 1929 isn't just about markets and money. It's about human nature, about our tendency to believe what we want to believe, about the way crowds can be simultaneously intelligent and completely wrong, about the fragility of systems that seem solid until the moment they shatter. These lessons aren't academic. They're urgent. They're personal. They affect every one of us, whether we're investors or not, because when financial systems collapse, everyone feels the consequences. So pay attention to the patterns. Question the narratives. Don't assume that just because something hasn't happened yet, it can't happen. And remember that the people who survived 1929 with their wealth intact weren't the ones who predicted the exact top. They were the ones who stayed disciplined, who didn't get swept up in mania, who prepared for bad times even during good times. The choice is yours. History is offering you a warning. The only question is whether you'll listen. If this video made you think differently about your financial future, hit that subscribe button and turn on notifications. Share this with someone who needs to hear it. And drop a comment telling me what warning signs you're seeing in today's economy. Let's learn from history together, so we don't have to repeat it. The future isn't written yet. We still have time to choose a different path. But that window is closing. Don't let it close while you're still sleeping.